Ira Epstein with your agriculture wrap-up, and this is your weekend edition for Friday, February 28th, 2020. Wow, what an interesting day. If you take a look at the grain markets, all over the board today. I mean, all over. Now, today was one of these days where you had liquidation selling hitting in a number of markets. You saw it hit in the metal markets especially hard, be it platinum, palladium, silver, gold. They got smashed. And, you know, this was the week we heard everybody saying you got to own gold in your portfolio. I was listening to it all week and writing in my newsletter. I said, when everybody's telling you to do that, you don't want to do it. Just the way that it worked out. As for the grain market, corn is stable. Grains are starting to break away from this nervousness about the COVID-19 as best as they can. That's the only phrase that I could use. There's no way to know where the stock market's going to go. If you get worse news over the weekend, down we go again. Today we saw at 2:30 in the afternoon, and this does impact the grain markets and the meat markets. We saw the Fed chair come out, Powell, and basically say he's got the markets back. But what we probably want to do is once there's a peak in this COVID-19, I think the G7 gets together and they all come out with a statement and actions. That would be the coordinated effort you want. It was nice that he came out and said that, but it's words, and it would be a waste of their bullets to step in front of the COVID-19. I'd rather that he just say, we're going to be there, let the psychology be there, and then shoot your bullets, if you will, when they have a meaning. So if we come over and you look at the monthly chart of soybeans, the bigger picture shows you the market is just sitting on its 18-month moving average of closes. That's what this is, 18-month moving average of closes. Just sort of sitting right on it. 983 and a quarter is the number. You're at 983 and a half. And we've been playing that way for a while. If I step back here with you, if you take a look, this was back in the month of September. The end of September. You haven't really gone anywhere since then. You've tried the upside, you've pulled back to it. Now, as you know, in the weekly edition here, we review weekly charts to get an idea of the bigger picture. And the bigger picture, as you can see, has been a wave down, but in all fairness, the market, and I've pointed this out over the past couple of weeks, this is another support level. The market keeps probing the top of it, hasn't really done anything going into it. The trend is down. Why? Because you've got a pattern of lower highs and lower lows as measured by the swing line. This is that chart without it. When I put the swing line on, it puts the lines where they belong according to 5 rules that I wrote in my charting course. You're looking at higher high weeks, lower low weeks, an inside week, an outside week, up or down. And there's a specific rule attached to where the line gets drawn. Right now, in order to break the downtrend, the market has to get back over 902. Where's the line in the sand, the neutral number? It's the 18-day average of closes, this red line. Underneath it, which is not bullish, it's bearish in a way, let me explain that, is the 100-day. Now, what's bearish? It means there's 2 levels of resistance on the way up. That's what I mean. A more bearish scenario would be if the 18-week average got under the 100. That would be a very bearish scenario. It's called a bearish crossover. You don't have that at this point. You had at one point a bullish crossover. You went up one time with it, and you let go ever since that point. So now I have 2 resistance points on the way back up, if there's an up, and why not, 897 to 906. When I look at support in the market, the theory of the black dashed lines, they're called Bollinger Bands, is that it's an algorithm that'll keep the market trading within it 95% of the time. The first time you hit it to the upside, I tell traders, and this is what I teach in my charting course, come out. Take off part of your position. At minimum, your stop orders moved way up. Hit the bottom. Come out if you're on shorts. Move your stop down if that's what you do. Back into the resistance and the market down. So we're still in a downtrend. We've hit downside targets, some support zones, and momentum is still pointing down. In summation, lower highs, lower lows, bearish. Under the 18 and the 100-day average, bearish. You target 865 and a quarter from where you're at right now on this current break. It's about 18 cents away, and momentum is still pointing down. Meal's a whole different world. The meal market came alive today, was able to close at 298.60 over the 296.90 level. The market also prior to this week had been in a downtrend, had already hit the lower Bollinger Band. Bias was down, momentum down. Comes down, hits that band again, finds support, and has an outside week up. Therefore, you're no longer in a downtrend. The momentum, by the way, is turned up. The bias is up. The pattern, because this week's low was 284.90, is underneath 286.40. So unfortunately, we don't have a pattern of a higher high, higher low. What do I think's going on? I think you're caught in this narrow band of the Bollinger Bands, and the market is winding, just like my finger is going in here, trying to figure out what next. Soy oil hit a big important number this week. If you take a look, that's the lower Bollinger Band. What do I say on the first time you hit that? That's where I think the pros are going to cover shorts. So I look for that to be the cover area. The market finished 28.31. Just over that lower band. First resistance point, the 100-week average, 29.38. You'd have to get over 31.27 on the current formation to break the bearishness. In the corn market, you reach down for what number? Let me take off this week. The market's in a downtrend. Lower highs, lower lows already, under the 18-day average, momentum pointing down. If it breaks, I'm looking for the lower Bollinger Band as a possible target, and certainly if it hits it, I'm going to do what I always say. First time you hit it, out you go of some of the positions, certainly move down your stops. That's what's happened. Trend down, bias down. You've hit an objective resistance, 377 3/4 to 379, and for the people that want to turn this market, you'd have to get this market on the current formation over 384 in order to break this downtrend. In the wheat market, how fast this uptrend ended, and all of a sudden, lower highs, lower lows. You're in a downtrend. Even if you had a rally back up to 570 3/4, all it could do is stop the downtrend, not convert to an uptrend. Resistance, 542 1/4. This is the target area if the trend continues down into the 506 1/2. Let's call it the 100-week average of closes to the lower Bollinger Band of 501 1/2. I would expect the bears to defend their positions right in that 542 1/4 zone. When we come to the sugar market, you broke just enough to 1403 to get under this number. Now, the Sugar Association came out today, I'm talking the international one, saying that the world sugar is going to be in a deficit due to the high demand for ethanol and the like. Okay, we've had a big run-up. Is this where the market consolidates? You've stepped out of the uptrend. You had been running this upper Bollinger Band. And the first time you hit it, I'll say what I did before. And admittedly, for 3 weeks, you kept running. And now you've pulled back under that number, and we'll see what it can do. So I look for support at the 1379 level, the 100-day average of closes. In the coffee market, on the longer-term picture, we're still in a bear market. Lower highs, lower lows. What would negate it? Taking out 111.50. Now let me give you what coffee's got to deal with right here. If the U.S. gets more cases of COVID-19, if an American city, and I'm not saying it would happen, would get quarantined, we already saw in China how many of the coffee shops closed. What would that do to people just going out on their way to work? They're already prepping all of us to do what? How do you work at home? What else do you do if this thing turns into something bad? Knock on wood, it has not in the U.S. so far. It has in other countries, and as you know, over tonight, Saturday, and Sunday, we're going to hear whatever we're going to hear, and nobody has control over it. So, bears still in control, momentum has gone flat, trend and bias are down, but this market's trying to make a stand now at the 100-week moving average of closes, getting over 111.50, negates the downtrend, sets up for a possible challenge of the 114.75 level, the 18-week average of closes. Cotton and export market annihilated on this break. Lower highs, lower lows. The good news is this is where I think pros took some money off this week, right against that lower Bollinger Band. Resistance back up at 66.92, but you got to get over 69.03 to break the downtrend on the current pattern. Cattle, monster decline for the week, down 6%. And what this is, again, export markets of meats and so on. People aren't going out. We're sitting here with an unbelievable amount of poultry that has yet to be shipped, that was supposed to be shipped out of the U.S. All of these markets feeling the pressure of COVID-19. The hog market has suddenly decided, I am not so bearish. It's very interesting. It was down 7% for the week. So let's not take what's going on here lightly. It's still lower highs, lower lows. The settlement at 62.27 is still under the 18-week average. But to negate this downtrend, you could even turn the trend up if you got over 68.25. Bears are still in control of the market. Momentum has gone flat from pointing up. So you put it together, you come up with game plans, and that's what I do for you each morning. I wake up at about 4:30 in the morning, and I read an awful lot. By 5:30 in the morning, I've read from Asia into Europe, read about grain markets, I'm reading about meat markets, I'm reading the U.S. news. And then at about 5:45 a.m., I begin recording 40 charts in the morning. Now, obviously, you don't want to see me in my robe, so what I'm doing is I do it with a headset on, and the charts look just like this. More studies than you're seeing here. It'll all be on the futures markets, and I cover them in detail. I'm not a bashful person, so I'm going to give you both the fundamentals that I'm seeing, the technical analysis, and what I think you should be doing in the market: buy, sell, stop, profit objectives, all those type of things. Maybe it's what you need to give you that edge that you've been looking for. Now, I realize if you're an ag trader, you may not want to be looking about foreign currencies and interest rates, so I've made it easy. On the bottom of our website, when you're looking at this video, right in the video is a scroll bar. As you move it, it'll flip up and tell you the different markets you're in. For those of you that want to watch the whole video, I do it as a learning experience for you. I teach as I'm going. Ideally, if you take the charting course, it all really crystallizes because you understand the different concepts, but it's all going to be there. How do I do this? Well, it's pretty simple. Every morning, and I mean every morning from Monday through Friday, I don't think I've missed one even with eye surgery this week, I am there putting out the video for you. It runs $7.95. Now think about it. A tick in cattle is more money. A tick in hogs is more. A tick in the grains is more. Can I make this any less expensive for you to try it out? After that, it's about the price of a tick. It's $15 every 30 days, but if you buy a year up front, I match that tick pretty close. By $13 a month, you just pay up front. How do you get this? You go to our website at www.iraepstein.com. Under the word research, it explains how it works. There's a web page there to explain everything. If you want to know more about the course, go to the education part. In the meantime, you have a great weekend. I'll see you all Monday.